Our next guest estimates that the strike could go on for 45 days, which could lead to catastrophic consequences. Joining us right now is Colin Langan, Wells Fargo's automotive and mobility analyst. And Colin, this is different than we had seen in the past. First of all, they're striking at all three at the same time, but they're not striking with every plant. So is this going to be a rolling situation? 45 days, if it lasts that long, what would be catastrophic? If they continue at the pace they're doing now, if they ramp it up, how do you kind of get your head around this?
Yeah, I mean, you're absolutely right. This has never been seen before, that we've never seen all three at once, but we've also never seen on a plant-by-plant basis. I mean, right at this point, I mean, they're doing about 10% of production, so this is pretty minor. It's actually kind of an underwhelming start in some ways in terms of all the rhetoric that went into this. I think Phil is probably right that the next wave is probably coming Friday, probably pickup plants. And so you're not cutting out the volumes, but we've estimated in the past full-size pickups could be 2/3 of North America profits. So you're hitting them really, really where it hurts. And I think they want to do here is continue to escalate over the next several weeks. And I think that's what's probably going to happen is you didn't start with the most profitable vehicles, but the next wave will be the most profitable vehicles.
When you say catastrophic, what's it mean for these companies' bottom line if a strike continues for 45 days?
Well, I mean, it's about $2.5 billion for GM and Ford if there's a strike for a month. So we're talking, $3.5 billion-ish, and then similar probably for Stellantis. So it's big dollars. But I think when I talk to investors, the thing that's most important is what is the permanent impact, right? You're going to make up the strike, but we're probably
if you agree to this to get everybody back, what does that look like for their bottom line?
Yeah, I mean, and that's what's material. I mean, we're talking about the wage demands are $2.5–3 billion from the UAW. The offers that they already have, per year by the end of the contract.
The offers they already have?
The demands that they have. And the offers they have today are over $1 billion, right, that they've actually put out at the 21% wage increase. So, there's a long way to go. We're talking about fixed costs, too, and that's the real pain point for the automakers. Ford's guidance is, 10 to 11 billion, right? So $2 billion potentially on an annual rate by the end of the contract. This is material numbers for these companies, which is why they're fighting so hard.
Even though they say it's only 7 or 8%. And are you taking into account 32 hours or any of the other things that are, you're not taking those into account?
No, it would be about 6 to 8 billion if you put in all of the massive lists of demands.
So, but you hear Sean Fain say it's a small amount. It's only 6 or 7% of costs. So that's just, what is that? What is that called, actually? Dissembling or duplicitousness or just using the right numbers and saying what you want to make your case?
It's just framing to make his case, right? So at the end of the day, margins in the industry are pretty thin, right? Globally, it's around 7% margins. So a percent here or there is very material. So if you're going from 6% to 8%, you've just cut out a ton of margin.
So you just also made a point that, so they complain, they say, well, the CEOs are making $20 million. So you're talking $6 billion to the company in expenses if they got everything. They're talking about just make the CEO make less money. You could do that for $15 million, right? If give him 5 or so, him or her 5, right? Instead of wouldn't that be better than trying to get 6?
That if they gave the money back, he said, forget it.
How about this?
That's what this is about.
How about this, Colin? So in the journal today, subsidies for unions will drive labor costs up, making the U.S. uncompetitive. Some of these are subsidies, and if I were an auto worker, turns out in the Inflation Reduction Act, to get the money, the tax credits, you need to pay prevailing wages, and then that means there are wage controls involved in you being able to take the money for the IRA across the board, whether it's green energy or any of these things that we're trying to stimulate production of. That's what we're trying to do. Why wouldn't the auto workers want the same thing? And if you could do that across the board with every union worker, wages are going to go up across the board.
I don't disagree. Wages will go up across the board. I mean, to be clear, the 6 to 8 billion is if they got all.
No, I understand.
So I don't think they're going to get all of them. But you're still talking probably 2.5, 3, probably $1.5–2 billion, probably a good base.
But we have a difficult. Is the EV transition going to be difficult with competitors like Tesla? Are emission standards that the automakers need to hit by 2030? Are all these things going to be difficult? And if 40% was agreed on, who's going to end up paying that 40%? Do you disagree it's going to be taxpayers?
I mean, I think at the end of the day, I don't think it's going to come directly out of subsidies. I think that the challenge here, you bring up a couple good points, so I'm not sure where to start. But first of all, I think there's questions about where will the jobs go if we do see such a big wage increase.
They're going to have their hand out when the automakers aren't competitive and start having, existential issues, which they have all the time. How many have they had so far? Remember a guy named Lee Iacocca? I mean, they've already had, we've seen this movie before.
We have seen this movie before. I mean, I think at the end of the day, that's why I'm underweight on both GM and Ford. It's not, the fact is this is not just labor costs, right? I think, unfortunately, they're negotiating at probably peak profitability. We have pricing that's probably going to come down. That's a multi-billion-dollar headwind over the next few years. And then you bring out EVs. EVs are very unprofitable. We did a teardown of 6 different EVs. The economics are very challenging. And so as they ramp these vehicles, it's going to dilute their margins. Plus, they're investing so much into this business.
We're funding the EVs with SUVs and F-150s and gas guzzlers. And we're funding their own demise, the own demise of the profit center, which is allowing us to make the transition. They're not going to be around anymore, are they?
Well, I think you're right. I mean, when I started the industry almost 18 years ago, the industry was kind of figuring out how many small cars they needed to sell in order to justify selling full-size pickups. And I think we're moving to a period where they're going to have to figure out how many unprofitable EVs they're going to sell in order to justify full-size pickups. So the dynamics are not good because it's very similar to what's happened in the past. So
when you say you're
industry.
underweight these stocks, I mean, if you look back to what happened in 2007, the union will point out that they took some serious haircuts, and they did, but shareholders got wiped to zero. So you're underweight. Would you warn people that this is a more dangerous situation than that, or underweight as you're flashing a sell sign?
I mean, I think, they ended up in bankruptcy. They have multi-billions of, $40 billion of liquidity at both GM and Ford plus. So they're not anywhere near that at this point. But they're unfortunately heading in that direction, right? I mean, a lot of the pressures in terms of regulatory needing to sell EVs, pricing probably coming down, and now we have labor inflation. And particularly, I'd be very concerned if some of the concessions that the UAW is asking for comes back. Retiree health care, that was $80 billion by the time they got rid of it in 2007. So these things could balloon overnight. Pensions for workers can be very costly. Reinstatement of things like Jobs Bank, these reduce their ability to sort of downsize as you need to, and there's always ups and downs in the economy. So you want to be able to do that. So these things are, big issues if they were to adopt them. I think those issues are non-starters. That's why I don't think they're going to get the 6 to 8 billion. But, that's kind of the magnitude of the demands that are being asked for here.